Hello and welcome to Fidelity Connects. I'm Alex Gabrini. This week, all eyes are on the Jackson Hole Symposium, where investors are waiting for Fed Chair Jerome Powell's take on the direction of the economy. With interest rate decisions, employment trends, and questions around U.S. exceptionalism shaping today's market conditions, how is Fidelity's Global Asset Allocation team positioning portfolios for the second half of 2025? Joining us today to share his insights is Fidelity Institutional Portfolio Manager and member of the Global Asset Allocation team, Ilan Kolet. Good morning, Ilan. Thanks for being here.
Morning, Alex. Great to see you.
Let's start with the big one that everyone's watching, the Fed. In June, you noted in your words that the Fed would likely love to be done, yet Jerome Powell is now facing pressure from Washington to act. The U.S. Treasury Secretary has called for a half-point cut at the next meeting, and we've seen dissent within the Fed with two governors publicly advocating for a cut. On top of that, last month's inflation report came in relatively tame yet sticky. So my question is, how is the GAA team thinking about the path for interest rates now that inflation is moderating but yet not back to target?
I think that's a great place for us to start, right? So there's a lot for us to unpack on this, but let's first start with what is the Fed trying to achieve, right? So the Fed is trying to achieve, as they've told us, right? They've been very explicit. They need inflation to moderate further. It's not, as you mentioned, back to where it should be. And they're at the same time, they're trying to balance that with the health of the labor market and just overall generally strong economic activity. What's priced in right now? Most investors are expecting in a month, at next month meeting, for the Fed to cut by 25 basis points, and about 50 basis points or two cuts are priced in between now and the end of this year. The thing to remember is interest rates are higher in the US than they are in Canada, which we can get into. But it wouldn't be surprising to me if the Fed did cut rates in September and then perhaps one more time between now and the end of this year. I think in general, we overthink every little meeting and every little move and every little dissent, which is natural, right? That's the industry we're in. The much more troubling issue, in my view, in our view, is the political side, right? The Treasury officials commenting on the appropriate direction for monetary policy. The separation of monetary policy and the government is critical to the credibility of a central bank and to the functioning of a central bank, and it's absolute. It's a cornerstone of central banking. So it's problematic for us when we see political officials commenting on the path of interest rates or firing the head of the Fed. Right? These are highly unproductive, troubling signals. Firing the head of the statistical agency. Right? This is not the type of thing that we need to see to sort of calm concerns. But I would say again, rates right now in the U.S. are above neutral. I would say somewhat above neutral, and for them to be reduced slightly, to be brought more in line with neutral, wouldn't be a surprise to me. Because again, inflation moderates slowly, which is what we've seen. The labor market can change quite quickly, right? And that's what they want to avoid.
Right. And Chair Powell hasn't caved to the pressure yet, and perhaps he'll reiterate that independence or the importance of that independence at this week's symposium. But shifting gears a little bit, because the Fed, as you mentioned, has a dual mandate, which is stable prices, but also maximum employment. I think you've noted that there are some red flags showing up on the labor side of the equation. Maybe walk us through what those red flags are and how that may alter the path.
Sure. So, economists love to look at inflation in the labor market, right? I remember when I was working as a research analyst down in Boston, I had a dashboard for the U.S. job market that had like 40 indicators on one page, right? So we often like to summarize things with an unemployment rate or the number of jobs added each month. It's more complex than that. And what I would say right now is the U.S. labor market, I would say broad brush, remains healthy and stable, right? The unemployment rate was exceptionally low, probably too low. It's drifted higher, which is very, very natural. But what is showing up now is there is a chunk of the labor market, probably about a third of the labor market, that is in pretty significant stress. If you squint, if you look at it very, very closely, if if Federal Reserve officials, if Chair Powell at the end of the Jackson Hole Symposium were to say that the U.S. labor market is generally healthy, that wouldn't be incorrect, right? I mean, again, we like to overthink certain numbers. And so what got a lot of attention, the labor report is released the first Friday of every month in the U.S., as it has been forever. I've been following it for 25 years, that first Friday of every month. And last month, we saw historical revisions. Now, what are historical revisions? Every single month, that number of jobs added is an estimate, right? And that's what it is. And when they receive more input and more input data, they revise that estimate, similar to almost how you revise earnings, right? So there were some downward revisions, which got a lot of attention because they're now politicized. I've never thought statistical revisions would be politicized, but they are now. But the revisions were negative, right? But again, we shouldn't expect the U.S. job market to be adding 250,000 jobs every single month forever. Right. There's a natural slowing that should occur as you reach the capacity of what that labor market can maintain. And we're sort of there, which is another reason why you might think, well, now is the time to perhaps normalize rates even further.
What data is going to come out between now and the Fed's next meeting, and what are they looking for? What signs are they looking for?
Yeah, so there's a heap of data that will come out. I mean, really every single month, every day. Some of it's more important than other data points, but I would say the first Friday of September, we will receive the jobs report for August. Right, that's going to be a critical piece of data, a critical input for the Fed meeting. But so too will business sentiment and inflation reports. And again, it's not just the CPI; it's CPI, PCE, PPI. There's surveys on prices, right? So for every one piece of data that we talk about, in here or on stage or with clients, there's really a dozen behind it that are either feeding that piece of data or are sort of complementary. I mean, for us, again, the way that we work with our researchers on the asset allocation research team is we have proprietary models that take into account a lot of this data. And we never just look at one data point, right? There's a whole host of indicators that we're looking at to sort of read the tea leaves in terms of the strength or direction of an economy.
Let's get into the conversation on the U.S. a little bit deeper here. For a long time, the U.S. has been the safe haven choice for investors. And I know last year you were talking a lot about a productivity boom that was supporting U.S. exceptionalism, and you had an overweight to the U.S. for some time. It sounds like your view on this has evolved. Maybe talk us through that evolution and what's changed.
Absolutely. So I would say this is the biggest change, right? So if we were talking 12 months ago, I'm sure we were, there's been a really material change in my conversations coast to coast with advisors and institutions and on the stage about how we're talking about the U.S. today versus a year ago. So a year ago, sitting here, I was talking about U.S. exceptionalism. I was talking about sort of the blowing up the standard 9-to-5 work week, a productivity boom that was being witnessed in the U.S., huge increases in labor force participation from female labor force participation or disabled labor force participation, really like structural changes that were happening in the U.S. economy that we just have never seen, right? I've never seen in my time as an economist. And really huge investments in CapEx, perhaps AI as well, but really something was in the soup that was pushing growth higher. And the reason that's important is growth was running higher than where it could be with slowing inflation and with a healthy labor market. Right? So normally when growth is running hotter than where we think it can be, that results in inflation. Right? So excess growth normally results in higher inflation because the labor market gets too tight, you have to pay people more, that wage growth turns into inflation. But we weren't seeing that. And the only way to square that is that the stall speed of the US economy had risen. I mean, it's remarkable. It's a great checklist, right? Because you get stronger growth with slowing inflation, healthy labor market, earnings revising higher, equities doing well. Who doesn't want that? Right. It's a very different story today. Yeah. Right. So we wrote a paper in, Q2 and Q3. We read a quarterly thought leadership paper. And in those papers, we put forth our latest thoughts in a jargon-free way. right? They're investor friendly, they're advisor friendly. I mean, they better be, or tell us. And we've talked about the underpinnings of U.S. exceptionalism have come under attack, right? And what is that? Strong, stable, and predictable policymaking, right? That general sort of the U.S. playing the role of the referee in terms of global business, that has come under pressure, right? And we saw what that resulted in the early part of this year with U.S. returns, U.S. markets falling precipitously.
Right.
I mean, there's been some buyback there, but we're still fundamentally concerned about the U.S. because, again, there's just too many things lining up that really question the underpinnings of exceptionalism.
Yeah.
I mean, firing the head of a statistical agency is seriously problematic, right? It happened in Argentina. Go look that up and see what happened there.
Yeah.
Right. I mean, it's problematic, and I don't think I'm exaggerating when I say that. It's seriously problematic, and there's been a few of those signals.
And you've reduced your exposure to the U.S., as I've noticed in your portfolios over the last 6 months or more. But the U.S. is actually showing remarkable signs of strength right now in the market. Do you view that as a head fake, or is that something that could be construed as kind of a reversal?
Well, so it's interesting, right? We are underweight, as you mentioned, we are underweight U.S. equities right now in our portfolio. So if I think of the Global Balanced 60-40 portfolio, it's about a 4.5% underweight to U.S. equities. Whereas we were overweight U.S. equities from August of 2023 until really the start of this year, right? And that was incredibly helpful in a year like last year, right? To be leaning into the U.S. Mm-hmm. We're leaning away, and we have been leaning away this year, but there's a couple of things to note. So first, we don't put a lot of stock into the most recent U.S. performance. We don't think the underlying structural issues in the U.S. that existed 5 months ago, 6 months ago, have gone away. In fact, you could argue that they've probably gotten worse.
Right.
I think it's interesting that tariffs, right, which probably caused or were the trigger for the pullback earlier this year, effective tariffs are now sort of being viewed as probably not that damaging. I think it might be a little bit too early to call to sort of sign that one off, but so far it seems that effective tariffs, in the case of Canada, the stuff sort of covered by the USMCA blanket, is not as bad as we would have expected.
Right.
But the thing to keep in mind here is, and I know a lot of people will know this, I mean, you know this, an underweight to U.S. equities doesn't mean we don't own any U.S. equities, right? It means, I don't know, the 30% of U.S. equities that is in the Global Balanced Fund, we trim by 4%. There's still plenty of U.S. equities in these funds, core building block managers. We can still win in that space. We just think there might be other parts of the globe,
right,
that will perhaps win the race this year against the U.S.
And I'd love to explore those other areas that you've pivoted that overweight into. But I wanted to ask you, Mark Schmale, portfolio manager for Fidelity Global Innovators class, mentioned pivoting back into AI back in April as usage began proving, in his words, useful, not just cool. Mm-hmm. And I wanted to ask if GAA is adjusting its assumptions around productivity growth, or earnings for that matter, corporate earnings, in light of accelerating U.S. adoption in the U.S.
Yeah, another really good question, and actually follows on beautifully from the previous one, right? So it's only a matter of time before, instead of us sitting here, it's digital avatars, right, talking to the advisors. But even though we are underweight U.S. equities, we can still win, right? And Mark points out a really good point. Mark is a core building block manager in many of our strategies.
Right.
If Mark wins against his benchmark and we own him, we win as well, right? So there's really two ways for us to win in these funds. The first is we overweight Europe instead of the US, and Europe does better than the US, and we win that way. That's the asset allocation. And the second one is the security selectors. Right. So again, it's an important clarification point that you brought up, Alex, that we're not foregoing, the AI adoption story at all.
Right.
In fact,
we're still participating.
Absolutely.
Yeah, you've shifted a little bit of that overweight elsewhere, and I noticed that your most recent white paper is titled "On Our Way Home," mm-hmm. and I can only assume that means that you've aggressively repositioned assets towards Canada. Is that true?
Well, yeah. So, I mean, on our way home, again, I encourage everyone to read it. It's a pretty significant change, right? So I joined the team in the start of 21, but for even predating me on the team, we have been underweight Canadian assets, right? Meaning we've been underweight Canadian equities and meaningfully underweight the Canadian dollar, right? And there's a significant shift that has occurred. We've been buying back Canadian equities. We're roughly neutral Canadian equities now, call it in the global balanced portfolio, right? So that's meaningful, right? So that's a 21% of the equity sleeve of that portfolio is now Canadian equities, whereas in the past, that underweight, as you know, has been -4, -6, -8, right? And we've been leaning away from Canadian equities. So that we've neutralized that, right? And that's a meaningful change because Canada's galvanized, right? Canada has galvanized. Some of that is the effect of tariffs. Some of it has yet to show up, if we're being quite honest, right? So removal of interprovincial trade barriers, right? Pushing productivity higher, which hasn't pushed higher in decades. We are cautiously optimistic that we're starting to see some policies that will kickstart that productivity growth. That's very, very positive. I mean, the other side of it is the Canadian dollar, right? Which I know we're going to get to as well, but the composition of the Canadian dollar position has changed, as has the size of it as well.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
It looks like you've also increased your exposure to international equities a little bit as well. Is that Europe, emerging markets, and why have you sort of diversified more internationally?
Yeah, so, as asset allocators, I mean, you can't be defensive everywhere, right? If you're defensive and you're leaning away from the US, there's also areas where we can find opportunity, right? And this was really fantastic input from our research team. Again, the team I used to sit on. They were quite early to the thesis that, we really should be leaning into Europe. And if I go back to our process, right? So we have a 4-pillar investment process that's macro, bottom-up, sentiment, and valuation. Valuations are not a good timing tool, right? So forever I was talking about attractive valuations in Europe and attractive valuations in emerging markets.
Right.
I feel I've been talking about that for years, right? But valuations, the way that we kind of think about valuations is valuations need a catalyst in order for them to really become investable, right? And so in the case of US, excessive valuations or frothy valuations, the way that we justified that last year was, well, exceptional valuations are being justified by US exceptionalism. And now that's come under attack. And in the case of Europe, again, very attractive valuations. And we believe that earlier this year, we saw that catalyst, right? So I think in our Q2 paper, we have a chart, which I never thought would show up in a paper, on German defense spending as a share of GDP.
Right.
Not a chart that you'd normally see in one of our papers, right? It's 1% for 20 years, and it hooks straight up, right? Because something happened in Europe where they realized, look, the US is no longer the referee that we thought it was, and it's galvanized Europe. And so we, as you correctly pointed out, we have a meaningful overweight to European equities, and as well an overweight to emerging markets. It's slightly smaller, but again, emerging markets is another place where we've talked about attractive valuations forever, and I joke, we've been waiting a long time for emerging markets to emerge, right? So maybe now is the time. But again, as asset allocators, we want to lean away from things that we think are going to underperform and lean into things that we think will outperform.
So you're not in the business of predicting these valuation catalysts, and your repositioning of assets internationally is not so much a case of the best house in the bad neighborhood. There are actually constructive elements supporting that positioning.
Absolutely, right. And if you listen to Connects with Ramona, or you look at her performance, that's a great example, right? Of leaning into some of these European defense names, and really it's showing up on the security selection side,
Absolutely.
and boosting and helping to boost our performance.
Yeah. In relation to currencies, I think at the beginning of the year you had a 20% overweight to the US dollar. Where does that stand today, and which currencies have you added exposure to?
So this is another really important point for us to talk about, this is something we're gonna spend a lot of time talking about for the remainder of this year, in some of our events. Is not only how we use the currency, right? So let me start with that, if that's okay. I'll sneak in a question you didn't ask, and then how it's evolved, right? So historically, we have used our currency, right, being underweight the Canadian dollar or being overweight the US dollar, as an additional layer of diversification and a way to smooth out returns, right? So if we know the Canadian dollar is a very cyclical currency, so if we can be underweight the Canadian dollar at times, it helps to smooth out the return for the end investor. Right. We've written a lot on that. Yeah. But the composition of that underweight, and I'm going to get a little nerdy here, I mean, unsurprisingly.
Please do.
Has changed pretty meaningfully. As you pointed out, in the past, when we've had a large underweight or an underweight to the Canadian dollar, that's really been an overweight to the US dollar, basically. Right? But given what we've observed year to date, right, this underpinnings of exceptionalism coming under pressure, the US dollar depreciating, that we viewed as a real structural change, and we wanted to reduce our exposure to any further US dollar depreciation. And so what did we do? We did two things. First thing we did is we pulled in our Canadian dollar underweight, meaning we're less underweight the Canadian dollar today than we were at the end of last year. As you rightly pointed out, it was a -18, -20%. Today it's a -3, -4%. That's the first point. So much smaller underweight to the Canadian dollar. But perhaps even more importantly, that underweight, that -3 or 4% to the Canadian dollar, in the past, it would have been a 3 or 4% overweight to the US dollar. Right. Now it is a 3 or 4% overweight to everything but the US dollar, right? The yen, the pound, right? The euro, not the US dollar. And again, it's sometimes tricky to talk about these in webcasts like this or on stage, because it is a nerdy kind of concept. But the way I would characterize it is it's another additional tool that we have to smooth out volatility and enhance return for end investors.
Right, fair enough. So you're using these as tools for diversification.
Exactly.
Does it also mean that you're anticipating further depreciation of the US dollar in that case?
Well, so given what we've observed so far, I mean, it wouldn't be impossible to see further depreciation of the US dollar. I'm very reticent to forecast exchange rates or oil prices. And somehow every job I've had, I've been tasked with doing both of those things. But what we wanted to really do is just kind of insulate the funds from further US dollar depreciation, right? Which, I mean, the US dollar was at an extreme level last year. It has depreciated and sort of stabilized a little bit. But for us, again, when I started on the team in 21, Jeff Stein, our now retired CIO, said, the way that we add value in these funds is we add 1 basis point to the mountain, 1 basis point at a time. Right. And so we're always thinking about these various levers that we can pull, levers, to enhance return.
Sounds like you would fit in nicely at Jackson Hole this week.
Yeah.
I'm always curious about the process. Would you mind maybe giving us a window into the GAA team's process for scenario analysis? Like what types of tests or stress tests are you running today, and what might cause you to pivot from your base case?
Yeah, so there's a lot kind of that we can unpack there. I mean, for advisors who are watching right now or listening, they know myself, they know David Wolf, they know David Tulk, and they know, they're a great Fidelity wholesaler that they work with. But behind our team are a host of people that we work with and meet with regularly that really contribute to the success and the management of these funds, right? Portfolio analysts sitting in Boston, a quantitative team also sitting in Boston as well. And we meet with them every single month. Actually, this is a meeting that I run that we had last week. And in this meeting, we bring together anyone who contributes to the analysis or the management of our funds. So that includes myself and the two Davids. Our president is invited, the CIO, any quantitative analysts that contribute to our funds, and the portfolio analysts. And we review every single fund and every single number every month, right? So This is like, imagine going in for a medical with your doctor and checking every vital, but instead of just you, it's like everyone in your neighborhood, and you're doing it once a month, right? So it's a very, very detailed analysis. And part of that is, again, our process is based on macro, bottom-up sentiment and valuation, right? And we're looking at signals that feed into those. But as you rightly pointed out, Alex, we're also doing scenario analysis, right? And we talked about this a little bit last week, where we have a quantitative team, a fantastic team of quantitative analysts that help us answer the following questions. If we were to see, a 2001 type of pullback, what would it mean for our funds? If we were to see a COVID type of shock, what would it mean for our funds? Right. And what that quantitative analyst is doing is taking a bunch of really important historical events, right? 2 standard deviation move in oil prices or in the dollar, and layering that type of shock into our funds based on what we own in terms of the building blocks, in terms of what we own today. Right. So I'm a huge fan of counterfactuals, right? Like I always say, like, had it not been for beer, I would be an Olympic athlete, right? So I'm always a fan of these counterfactuals, and this is a really powerful counterfactual that we do, and we update and examine every single month just to take another view as to how we're examining some of the positions and risk in the funds that we manage.
Right. I'm always curious, how do new building blocks make their way into the portfolios? Because over time you've added more and more tools.
Right.
And gold, for instance, is a position I believe you have an out of benchmark weighting in right now. So maybe how does that decision get made?
Sure. I mean, again, every answer to every question can come back to research, right? And so, in fact, I did some of the research on the efficacy of gold and commodities when I was in my previous seat as a researcher. Right. But speaking more broadly on new building blocks or new managers, the way I would characterize that is there's a lot of research that's going on that people don't see, right? That we don't get to talk about here until it's baked into the funds. Great example of that is last May we added 3 Fidelity Canada liquid alternative positions into the managed portfolios, right? And a dedicated sleeve of private real estate in the private investment pools. There were months and months of research that went into examining counterfactuals. What would the return have been had we had this? What will it do to risk metrics, right? So there's this ongoing agenda of research that underpins our funds, and sometimes it results in, yes, these are asset classes or new managers that we should add, and sometimes it's no, we're not going to add this because of drawdown risk, right? So
you view that gold as an example as a position that you're likely going to continue to own as an out of benchmark play?
Yes, I would say so. I mean, that the gold position has been there for some time. It's wiggled around a little bit in terms of size.
I assume your team has done the same research on Bitcoin, for example. Small positions of Bitcoin have shown up in our all-in-one ETFs, but I have not yet seen them in your lineup, the managed portfolios.
Right. So sometimes when the Bitcoin question comes up, I say, "Oh, I think we're out of time." Right. But
we almost are.
but to be quite frank, Bitcoin and crypto, we did the same sort of research, right? That research that went into the alts and the private real estate, we did that same sort of research. And given the volatility of that asset class, we decided not to add it to the managed portfolios. But nothing is preordained, right? So that research will be ongoing, and will be ongoing. But at the current time, we arrived at the decision really not to add it while it is in the all-in-one.
Fair enough. We've got about a minute left here, Ilan. I'd love to hear maybe what your takeaway is on what the biggest market risk is that we're facing today. Is it that may be overlooked by the market? Is it valuations? Is it stagflation? Or is it something else entirely?
I think, and this question has come through from a lot of wholesaling teams, with the recent move in the US, right, that really strong performance, I think it's very easy to look at that strong performance and say, you know what, all of those things undermining credibility and US exceptionalism are probably fine because we're seeing really strong market performance. I think sometimes we tell ourselves narratives that make us feel good when the line is going up. We are still concerned about that undermining of exceptionalism. Right. It doesn't mean we don't own any US, it means we're leaning away slightly in favor of other areas.
So what would your key takeaway then be to advisors?
Yeah, again, I think the thing with the portfolios that we manage, if I think about the managed solutions or the private investment pools, is they are elegant solutions to complex problems, right? Think of the breadth of the conversation we had today and where we went. These are things that we're thinking about every single day and working with fantastic researchers and underlying managers. And again, it's the reason, it is the key ingredient to their success.
I think that's the perfect place to end off. Thank you very much, Ilan, for joining us today.
Thanks, Alex.
We appreciate it.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.